All right, so in a prior video, shared a little bit about standard deduction versus itemized deduction. And for some of the itemizations to actually have any benefit to you, you have to exceed the standard deduction amount in total combined deductions, which in 2024 was like $29,200 for married couples filing jointly, $14,000 and change for single filers, and a little over $21,000 if you're filing head of household. So that's a pretty high bar. Only about 5 to 10% of households are itemizing on their taxes. But if you're wondering if you're close, make sure you're getting all of your available deductions. So this includes mileage tracking that you spent on charity, what you gave to charity, the value, the fair value of items given to charity throughout the year. So get your receipts from your Goodwills and your Salvation Armies. Of course, any cash or investments that you gave to charitable entities. Mortgage interest. There's some limitations on HELOC interest and I think investment property interest, but at least your primary mortgage and potentially some of the other interests that you have out there. And then a lesser known one is your property taxes. So what you paid and your property taxes on your primary residence, even your property taxes on your vehicles and other crafts. All of that can go towards itemization. If you had a year where you had really elevated health expenses, there's a hurdle that you have to clear. I think it's like 7.5% of your adjusted gross income. But if you really had a lot of medical expenses, that can really move you forward on the itemization train. And if you can get over the standard deduction amount, then every dollar above that amount just helps you on your taxes. So hopefully this is insightful. And if you have questions, let me know.